All right, ladies and gentlemen, welcome. Good afternoon. My name is Gordon Late. I'm the Vice President for Sales for NEI here in Ontario and snowy Ottawa this morning. I'd like to welcome you all to the October 26th webinar by Alterna Bank and Alterna Wealth. Today we have two presenters, John Bai, who's the Chief Investment Officer of NEI, as well as Yufei Man, Portfolio Manager and Director. Who are going to be spending the next 45 minutes or so looking at a look back at 2020 and looking forward through the remainder of 2020 and going into 2021. Today's session is being recorded. We are not going to be able to accommodate just due to the sheer number of people, a live Q&A question. So if I can direct your attention to the screen, if you do have, and there have been a few pre-submitted questions, if you do have a question, please, at the bottom of the screen, you'll notice there's the chat icon. And please do, if you have a question, type in your questions there. Again, given the sheer number of people that we have on today, we may be able to get to some questions, maybe not all, but please do submit them. We are recording them. And if we can, we will make sure that we have your questions answered by your Alterna representatives. Before we turn it over to the formal presentations, I'd also like to introduce Mr. Sean Kimji. He's the VP of Wealth for Alterna Wealth, who will open up and start with the opening commentary for our presentation today. Thanks, Sean.
Great. Can you hear me, Gordon?
Yes, we can. Thank you.
Great. Thank you very much, and thanks for the introduction. As Gordon mentioned, my name is Sean Kimji. I'm the Vice President of Alterna Wealth. At Alterna Wealth, we really strive to ensure that our members receive the best financial advice possible. Whether it's financial planning, estate planning, whether you're in your golden years in retirement or you're approaching retirement, what are the best strategies that you can employ to ensure that you have the best financial future and outcomes possible as you grow your wealth portfolio. I wanted to just mention that we have been partnered with NEI for a number of years, and NEI is the leader in responsible investing, and that's important to us because we find that their strategy, in fact their ideology, correlates very well with the values we hold dear to us as a cooperative institution. Today's webinar is especially timely because we are in what many would say now is a second wave of the pandemic. This started way back in March. It seems that time has flown, and here we are again with many areas, both in Canada and around the world, going into further lockdowns. What does this mean for your investments, for the economic outlook? In today alone, but over the course of the last number of months, we have witnessed extreme market volatility. We are seeing what many are watching, I'm sure, very closely, the U.S. election, which is scheduled to occur in 8 days. And the next U.S. administration will really shape the recovery of the pandemic and the economic future, not only in the U.S., but likely globally. So the outcome of all this is really, what does that mean to me and my portfolio? And with that, I won't take up any more time. I'll pass it back to Gordon to introduce our guest speakers, and then we'll follow up with some questions. Thank you, Gordon.
Thanks, Sean. Our speakers today, as I said, are our Chief Investment Officer, John Bai, and Portfolio Manager and Director, Yufei Man. Before I pass it off, I'd like to actually just read their bios and give you a brief introduction before we pass it off to Yufei, who will be presenting to us first. Yufei Man joined NEI as part of, joined Visa Wealth in 2013 as part of NEI Investments as lead portfolio manager and director of asset allocation and investment strategy. Yufei oversees research, portfolio construction, trading across all of NEI's asset solutions. And prior to NEI, Yufei was an investment analyst at Toronto-based long-short equity hedge fund. Yufei received a Bachelor's of Applied Science in Mechanical Engineering from the University of Toronto and holds both the Chartered Financial Analyst designation and Chartered Alternative Investment Analyst designation. I'll turn it over to Yufei, who could start the presentation and proceedings right away.
Okay, great. Thank you, Gord, for the introduction. And a big thank you to Alterna Credit Union for having us today. And more importantly, good afternoon, and thank you to all of our members who have taken time out of your day to tune in. For today's presentation, I will do a quick review of 2020 so far, address some of the recent headlines and volatility around the coronavirus, what the upcoming US elections mean for markets, and last but not least, where we think markets will go for this year and beyond. And then in a few moments, you will hear from our Chief Investment Officer, John Bay, and he will discuss some thought-provoking long-term investment themes. So let's get started. I will start with a quick introduction to NEI and what makes NEI unique in the Canadian investment industry, which is our leadership in responsible investing. So what is responsible investing? It is the way of incorporating environmental, social, and governance factors, so we call that ESG, and we incorporate them in investment decisions and active ownership. And ultimately, we want to help companies achieve sustainable business models. So there's this old school of thought that corporations exist for the sole purpose of benefiting their shareholders. But corporations today need to think about how they benefit all of their stakeholders, which includes not just their shareholders, but their employees, their clients, as well as the communities and the society around them in which they operate. The environmental, social, and governance framework is how we go about being a responsible investor. So when we evaluate companies that we invest in, we don't just look at the financial metrics. We also have to consider risk factors that fall under these E, S, and G factors. So if you look at the timeline here for NEI, we started in 1986 as ethical funds, and actually ethical funds was started in the credit union system. And if you look at this timeline, NEI has been a pioneer and consistently at the forefront of responsible investing. As you can see, we've been the first in many industry initiatives. So today, some of the key issues that are front and center are issues such as climate change, executive compensation, data privacy, as well as diversity and inclusion. And NEI has been at the forefront of tackling these issues. And if you wish to learn more, please visit our website at neiinvestments.com. Now, NEI Investments is also part of Aviso Wealth. We are an independent Canadian-owned wealth management company. And in fact, Aviso is actually owned by the credit unions, which means that if you are a credit union member, you have an ownership in Aviso. And as the provider of wealth management solutions to credit unions across Canada, Aviso Wealth and NEI, we're here to provide you with a full range of wealth management services and products. And through NEI Investments, you get access to a global network of investment expertise. We partner with investment managers from all around the world, and their expertise is in stock selection and bond selection. Now, we currently have 18 external partnerships who collectively manage more than $7 trillion in assets. That's more than 4 times the size of the entire Canadian mutual fund industry. And it's this global expertise is what NEI brings exclusively to the Canadian market and to Canadian investors. We also have internal investment managers here at NEI, myself included, who oversee the asset allocation across your portfolio. So that is creating portfolios using various investment strategies that are a blend of stocks and bonds diversified by geography and by sector. So let's start by talking about what happened in markets this year. So prior to 2020, we were in this incredible 11-year bull market, and it was the longest on record. And all of that came to an end on February 19th, which at the time was the all-time high for the stock market. So as the COVID-19 spread, social distancing measures had to be taken, which resulted in many parts of the global economy being forced to shut down. And what makes this year's market downturn different from previous ones, such as the 2008 Great Financial Crisis, is that we saw a major disruption to both the supply and the demand side of the global economy. Okay, so what does that mean? Well, in this case, a supply shock was created when governments issued social distancing measures, which forced people to stay home and thus leading to a reduction in the workforce. Less people working leads to lower productivity and therefore lower economic growth. The virus also created a demand shock. So travel restrictions and people staying indoors means entire industries such as airline, leisure, tourism, retail, hospitality, they've all been very hard hit. And most developed economies rely on consumer consumption or household spending as the primary driver of growth. Here in Canada, both in Canada and in the US actually, about 2/3 of our GDP comes from household spending. So this sudden halt in economic activity put us into 2 quarters of recession that was worse than what we saw during the 2008 Great Financial Crisis. And remember that stock prices reflect future expectations for economic growth. So as soon as lockdown measures started to be announced, the market started dropping. And in fact, the pandemic sell-off this year was record-breaking by many measures. So between February and March, we saw the fastest ever descent into a bear market as the S&P 500, which is a popular index that measures the US stock market, dropped 35% over 6 weeks. And then between April and August, the S&P 500 saw its strongest ever 5-month rally in 80 years. And as you can see on this chart, we went from all-time highs on February 19th to bottoming out on March 23rd, and then back to all-time highs on September 2nd. And it only took 126 trading days, which is the shortest amount of time ever in history. Usually on average, the recovery takes about 6 years. So let's zoom out now and look at the longer term trend. So this chart here shows bull and bear markets going back to 1960. A bear market is defined when markets drop more than 20% from peak to trough. And a bull market is defined as when markets rise 20% or more from the trough. So if you look at the chart, the blue shaded areas show how much stocks gained during each bull market, and the orange shaded area shows how much the stock market lost during each bear market. Now, clearly, not only do bull markets last far longer than the average bear market, but markets also gain a lot more during bull markets than how much they decline during bear markets. Now, that being said, being in the middle of a bear market can be quite unnerving, even for us professional investors. And I remember it like it was yesterday when we were all still working at the office and seeing all the negative headlines on TV, BNN Bloomberg or CNBC, and seeing the stock market drop more than 10% in a single day. And it's during times like this, when you're surrounded by fear and panic and seeing large dollar losses in your portfolios, that investors tend to make the worst investing decisions. And oftentimes, the best decision one can make during periods of volatility and uncertainty is to simply stay invested. Markets can and they will drop from time to time, but following each drop, they will also recover over time. And the worst thing you can do is to sell your investments at the market bottom and then miss out on the subsequent recovery. So hopefully most of you had the discipline to hang on to your investments during the March volatility. Now, the bear market this year was the shortest one in history. And if you look at on that chart, that tiny little orange blip to the right, and from there, back ever since as early as April, we've been back in a bull market and stocks have already surpassed pre-COVID levels. Now, the average bull market, as you can see on the chart, lasts about 5 years on average, which likely means that we're just getting started. So where do we think markets are headed for this year and into 2021? Well, obviously no one has a crystal ball that can predict the future, but over the next few slides, I will share some of the risks and opportunities that are on our radar. So to summarize our outlook, we are cautious in the near term as virus cases continue to rise, which means lockdowns are extended, which also means that economic activity may be more subdued despite the strong surge that we saw over the summer months. We think that more fiscal stimulus will be needed to keep businesses and individuals afloat, and that is just a matter of when, not if, that the next fiscal package comes for the US. And until then, as we've seen in the news lately, markets will continue to see some level of volatility. Now, nothing crazy like what we saw back in March, but definitely elevated levels of volatility. Now, over the long term, we remain pretty optimistic on stocks. Even though the stock market as a whole has recovered past its pre-COVID levels, more than half of the stocks in the US market are still negative for this year. And that's because the biggest companies such as Amazon, Apple, Facebook, Google, and Microsoft, they've all performed very well this year, and they're more than making up for losses in the rest of the stock market. And if you think about it, in a world of physical distancing, the companies that will thrive are the ones that do not require physical interaction with their customers. And as you can imagine, among these companies in the technology sector, which has performed obviously incredibly well this year. However, next year, we think the market narrative is likely to change. So next year, corporate earnings as a whole in the US are broadly expected to grow 26%. Now, earnings in the technology sector are only expected to grow 13%. So where's the rest of it going to? Well, corporate earnings in the consumer discretionary sector are expected to grow 75% next year, and earnings in the industrial sector are expected to grow 85%. So what does all that mean? Well, this year, it's been very much a tech story. Next year, as presumably a vaccine is rolled out at some point and made widely available, we are likely to see a cyclical rebound in the economy, and with that, a rotation out of the technology sector and into some of the other sectors that just have been battered due to the lockdowns. Now, let's talk about the US elections. And as you can imagine, this is one major source of short-term uncertainty right now in the markets. It's only 8 days away. Now, currently polls are showing Biden in the lead, and the Democrats are expected to take both the House and the Senate. Now, of course, back in 2016, the same polls were showing Hillary Clinton in the lead, and we all know how that turned out. So I'm not going to make a prediction on the outcome, but it is important to briefly discuss what could happen should either of the candidates win. Now, the long-term effects of the US election outcome is very policy dependent. On one hand, Trump wants more tax cuts, while Biden wants more fiscal spending to support Americans, and both should actually be helpful in stimulating the economy. It's just that they're targeting different segments of the population. We don't have too much clarity to make any predictions beyond that, so we'll just have to see at how things unfold. But in the short term, however, once the election passes is in itself a positive development, and for two reasons. So first, it removes one factor of uncertainty. It creates more clarity and allows markets to focus on the longer term picture, which again, in our view, is a bullish case for equities. Now, second, this much needed second US fiscal bill right now is currently being stuck in Congress because the two sides can't agree on a deal, even though the amounts are practically the same. And if a bill doesn't get passed before the election, one will for sure pass after the election. And whoever is the incumbent, they will have to pass a bill, and soon, because the last round of stimulus checks are coming to an end. And so, all in all, whatever the election outcome, at least in the short term, we think that it should provide a bit of a sigh of relief for markets, which would be a positive development. Now, once the US election passes and all the noise around it passes, we should have one less source of uncertainty, and we should see more focus come back to the economic fundamentals. So this chart here shows the latest projections from the International Monetary Fund, and it's for a 4.4% contraction in global GDP for this year, followed by a nice 5.2% growth for next year. So what this means is that the worst is likely behind us. So by many indicators, the third quarter for this year, we're expected to see a nice positive growth in GDP. However, it will take some time for things to get back to normal. And in this time, policymakers will need to continue stimulating the economy by keeping interest rates low and also maintaining some level of asset purchases to continue providing liquidity. Now, most of these asset purchases involve buying up bonds, which are issued by the governments. And so speaking of bonds, the story is not quite as exciting going forward, but that's okay because bonds did exactly what they were supposed to do back in February and March. They protected on the downside as markets sold off, but going forward, we would not expect significant returns from government bonds as interest rates will likely be pinned for the next few years to help sustain the economic recovery. So this chart here shows the yield on the 10-year Government of Canada bond. So the term yield is basically your average annual return that you would receive if you bought the bond today and if you held it all the way to maturity. Now, if you look on this chart, for the last 40 years, bond yields have been on the decline. There is an inverse relationship between bond yield and bond returns. So a decline in bond yields, as we've seen in this chart, actually results in higher bond prices. And if you go all the way to the right side of this chart, that sharp dip in yields resulted in positive performance in bonds since February. Now, currently, a 10-year Government of Canada bond only yields around 60 basis points, or 0.6%. And that would be the return that you would receive if you bought the bond today and held it all the way to maturity. So not a lot of return. Of course, corporate bonds, they'll pay you a little bit more, but you're also taking on credit risk that's related to the company that's issuing the bond. So, all in all, this doesn't mean that you need to go and sell your bond holdings now, because bonds still provide important downside protection during periods of market volatility. So, as long as the virus continues to spread and our economies stay only partially open, we will require further government support. So back in March, when stock markets around the world were plunging, central banks had to step in and restore confidence in the financial markets. They cut interest rates pretty much down to zero. They announced record amounts of asset purchase programs. And at least, for the next 2 to 3 years, we're likely going to see interest rates anchored near zero across most of the developed world. That also means that central banks are increasingly running out of tools to stimulate the economy, because what do you do when central bank balance sheets are at record highs and interest rates are at record lows? Well, as you probably inferred from the title, we will increasingly see fiscal policy take center stage. So you compare that to monetary policy, which is often referred to as a blunt instrument because it really only directly benefits the financial system, Wall Street and major corporations. But on the other hand, fiscal policy, which is more government spending programs, they can have much more precision. Governments can tailor these spending programs and target directly those in need. And in this case, it's really the individuals and small businesses that have been displaced. So despite markets back near all-time highs and the economy seeing positive growth for the last quarter, our unemployment rate here in Canada and in the US, they still remain at high single digits. So in Canada, it's about 9%, and in the US, it's about an 8% unemployment rate. Now, the long-term growth potential for any economy, it's partly a function of the size of its workforce in proportion to its overall population. And so the long-term displacement of these individuals, it could ultimately create a drag on potential GDP. So it is absolutely imperative that governments provide support where they can. Now, of course, there are those that worry about the increase in debt levels, but at the same time, consider that this is a global issue. So literally every single country is doing this. And you can see on this chart the amount of fiscal stimulus this year relative to every country's GDP, and it compares that this year's response to the response from 2008. And so you see that huge difference with the amount of fiscal policy that's been put into place for this year. And with interest rates expected to stay low for some time, the burden of servicing the debt should also remain low. And if interest rates do rise down the road, not only does that actually decrease the present value of this debt, it would also signal that our economy is in much better shape. And so one final slide for me. All of this government spending, it creates a once in a generation opportunity. So at least, for the last 5 years, and especially since signing of the Paris Agreement in 2016, many people have been talking about the need to transition to a low carbon economy. And there were many that were opposed to this because of, the enormous cost that it would incur. We're talking trillions of dollars. Well, guess what? With these government fiscal stimulus packages, we now have trillions of dollars backed by central banks. And what we've seen this year so far is that in every major economy, and you see them all listed here on this slide, they've all taken some measure to moving towards a greener economy. And I'm sure you can all guess NEI's stance on all of this. We welcome this with open arms. And it's not enough, though, to just transition to a low carbon economy. It needs to be a sustainable transition. So that means slowly phasing out industries with carbon intensive activities, and at the same time, creating new jobs in new lower carbon industries so that the net effect is job creation and not job destruction. And now we have government funding to help us move in that direction. And I think in the middle of this global health crisis, an opportunity to slow down or even potentially reverse some of the effects of global warming and climate change is something that we can all perhaps look forward to. And so that concludes my part of the presentation. Thank you very much for listening. And I will now turn it over to John Bay.
Thank you very much, Yufei. I'm now going to share my screen. And just give me 1 second while all these buttons pop up. Okay, there we go. Can you hear me okay, Yufei? Okay. Thank you very much, Yufei and Gord and Sean. Good afternoon, everyone. It's my absolute pleasure to be with you here today. Thank you so much for taking time out of your busy schedules to be with us here today. I'm going to start off a question with my part of the presentation with the question: is it possible for an oil and gas company to believe in climate change? First, I want to acknowledge that climate change is a difficult topic, particularly for Canadians who live out west. COVID has been particularly hard on oil demand. In fact, if you look at the latest forecast by the International Energy Agency, they are forecasting demand for oil to decline by 9.3 million barrels a day. And that's about 10 times higher than the effects of the global financial crisis. But longer term, the oil demand faces long-term headwinds, with the world moving towards zero carbon emissions by 2050. But even in this difficult environment, there are some Canadian companies that are seeing the long-term shift to a low-carbon future as an opportunity. Here on this slide, I'm highlighting Vermilion Energy as a great Canadian example of this. For instance, their operations in France, their oil and gas production facility is operating in innovative ways. They're taking waste heat from the extraction process that naturally heats water to 60 degrees Celsius, and they're using it to provide geothermal heat to a greenhouse operation that grows tomatoes on an industrial scale. And they're doing this free of charge for the next 25 years. And because of this ingenuity, Vermilion is able to grow, the greenhouse is able to grow 15,000 tons of fresh tomatoes. They're able to avoid 15,000 tons of carbon dioxide emissions into the atmosphere, and they're able to create 350 long-term jobs as a result of this cooperation agreement. So instead of spewing greenhouse gases into the atmosphere, Vermilion is using their oil and gas operations to use geothermal heat to grow fresh food and provide additional jobs for their local community. And it's this type of innovation that we see as critical for the next 10 years. So as we head into crisis, we entered this decade in crisis mode. There's a healthcare crisis, obviously, with COVID. There's the economic crisis that Yufei talked about with the economic shutdown. There's a social crisis with the Black Lives Matter movements, not just in the US, but globally. There's been an oil crisis with negative prices, something I didn't expect to see in my lifetime, and also a climate crisis with some of the apocalyptic forest fires that we saw in California, as well as the storm season, the record storm season we saw that hit the US Gulf Coast. So the key question here is, why is all of this happening? And so one of the insights that we need to realize is that the current economic system is broken, that we are living beyond the means of this planet, and that's creating increased exogenous shocks to many systems. It's no coincidence to me that in 2020, we are dealing with all of these crises, the economic, social, oil, and climate, and healthcare crisis that I just mentioned. So if we want to continue to grow the economy, we need a new kind of economic system, a new kind of finance, a financial system where lenders and investors are putting money to use in a way that's positive for the planet as well as positive for people. And we call that new kind of financial system sustainable finance. So while we enter the decade in crisis, the challenge is, can we end the decade with progress? And with sustainable finance, I think we have the tools to get that done. So in order to accelerate the change to sustainable finance, we need to accelerate 4 transitions that we're currently going through. And so as we look to the decade ahead, we see 4 transitions that the world and society is going through. We believe that the future, as we look ahead to the next decade, is smart, and that's a transition to a more sustainable society. And the future is also, and that's as we transition from a physical world to a digital world. For us, the future is also cleaner as we switch to from a high carbon world to a low carbon world. The future is also more resilient as we create a more durable economy that's able to withstand increased exogenous shocks. And we see that the future is fairer as we transition to a more inclusive economy where we see a better distribution of wealth. And so it's not just us who believes that this transition is underway. We're seeing major actors across the entire investment spectrum that are responding to this challenge to make this acceleration happen faster. We'll start with the central banks. There's over 60 central banks that have formed a network for greening of the financial system. And these central bankers are defining best practices in which the central bank can agree to and meet the demanding climate change risk to their economies. And this risk is on 2 fronts, both on the physical risks of the climate change, as I mentioned, the forest fires, as well as the flooding and the storming, but also the transition risk, as major parts of our economy are dependent on high carbon industries and the need to transition to low carbon industries. Regulators are also responding to this challenge. If you look at the 50 largest economies in the world, you'll see over 700 regulatory changes that have been put in place to support investors to consider long-term value drivers, including ESG, as Yufei mentioned, environmental, social, and governance factors. So not only are the central bankers and regulators moving, the asset managers are also responding. And over $100 trillion of asset managers signatories, that's 3,100 asset managers, have joined the UN Principles of Responsible Investment as signatories, saying that they will increasingly commit to managing their money in a responsible investment way. NEI has been a RI leader from the very beginning, joining the URN in its first year of operation in 2006. And corporations are also responding, and this was really a watershed event in 2019, where 181 CEOs of the largest US companies declared that the purpose of a corporation is not just to serve shareholders, that's what we call shareholder primacy, but much larger, which you call stakeholder theory, is that they exist to create value for all our stakeholders, including employees, the clients, the supply chains, the communities they work in, as well as shareholders. And that is creating some really interesting dynamics as we look ahead. And so investors are also responding as well. And so if you look at, this is data according to Morningstar's latest global sustainable funds survey, over $1 trillion of funds have been invested in responsible investment funds globally. This is the first time ever that we've seen sustainable investments exceed US $1 trillion. If you just look at what happened in the second quarter of this year, you saw in first quarter assets dipped as assets reacted to the COVID and economic and market crisis, but rebounded smartly in the second quarter, where flows into responsible investments increased by 72% to US $71 billion, and again, a record flow. So we're seeing increased momentum into responsible investing as investors begin to realize that portfolios can have a positive impact on social, environmental, and governance issues. And so what does this mean for you? It means that, that with the tools that we can add to your portfolio, we can actually add some environmental, social, and governance impact to your portfolios. If you look back over the last century, traditionally we look at optimizing portfolios but along two dimensions. That's along the risk dimension as well as the return dimension. And so what we're suggesting here is that tools have now evolved for us to have the ability to add a third dimension to your investment portfolio, and that is real world impact, where instead of just asking the question, what rates of return are you seeking and what risk are you willing to take, we can now ask the question is, what future impact do you want your investment dollars to achieve? Because the good news is that we can start to have an impact on the next decade ahead. Yufei introduced responsible investment in his opening slide, that responsible investment incorporates ESG analysis into company performance into their investment decision-making process, seeking to generate sustainable value for investors, shareholders, and other company stakeholders. And at NEI, our responsible investment thesis is that our responsible investing incorporates that companies can mitigate risk and take advantage of emerging business opportunities by integrating the best ESG practices into their operations. So how do we do that? At NEI, we have the highest commitment to responsible investment. And so what we do is we have on the top end of this slide is it looks at all of the investment considerations that we can do to responsible investment. Do we want to take a look at, is ESG a consideration, or is ESG part of some of the negative screens? As Yufei mentioned in that timeline, 30 years ago, we started the ethical funds, launching the first RI products here in Canada. And it was founded on the premise that we could make money and avoid investments in the worst actors in the marketplace, even if this was a big business. And so later on, we started to incorporate more ESG into our decision making and starting to engage companies such as Goldcorp to respect human rights in the indigenous communities they were mining in. We engaged banks to clean up lending and sales practices. And at Suncor, we also asked them to start planning to the transition to a low carbon future. And that's all active ownership responsibilities that we have on the bottom part of this slide, on the advocacy as well as on the engagement side. And so again, how do we have an impact on the environment? So for instance, this is a case study on the investment side where our Environmental Leaders Fund has invested in this company where it's called Precision Agriculture Practices, where they use GPS embedded in drone technology for precision fertilization to help farmers use less fertilizers and save on the fertilizer production. And with that precision agriculture, we can save 8.7 million tons of carbon dioxide annually, which is the equivalent of taking 1.9 million cars off the road. And again, here I have an engagement on the active ownership side, where we have engaged in conversations with Suncor over 15 years now to help them in their transition. In 2017, Suncor set a new goal of reducing emissions intensity by 30% by 2030. And they were a leader in North America as a result of conversations with us. And since then, ExxonMobil, Cenovus, Occidental, and Teck Resources have followed Suncor's lead on reducing their climate footprint. And so finally, my last slide here is that responsible investment is an area where institutional investors continue to grow. These institutional investors are the most sophisticated investors in the marketplace, managing your pension funds and endowment funds. There was a recent survey that had investors take a look at and ask them the questions: how many of you incorporating ESG into your investment strategy? 75% said that they were incorporating ESG into their investment strategy. Europe is in the lead with 94% of survey respondents saying they are doing it. Canada 89%, and USA lagging at 65%. And then why are you doing that? The survey asked. 84% believe that ESG will enhance returns compared to portfolios that do not incorporate ESG into their investment portfolios. Canada is leading the pack at 97%, believing that ESG will have a positive impact on portfolio returns. And that 67% also believe that incorporating ESG can help reduce risk of their portfolios. In Europe, 96% of investors surveyed believed that ESG can help reduce risk. And again, that's one of the main reasons why ESG, we're seeing such momentum in responsible investing in the marketplace. So with that, I'm pleased to say that, it's no longer a binary world where we can have one or the other. It's no longer just about sustainability versus profitability. The magic is that we can have both, and it's about the opportunity to create a smarter, more sustainable, resilient, and inclusive future. So with that, Gord, we have time. Do you have time for a video, or do we want to go straight to question and answer?
Actually, given the time we're going to go right to question and answer. And I think Sean had a couple of pre-submitted questions that he wanted to address. And I've got about 2 or 3 questions that I've received as well that we'd like to address. So with that, if Sean's there, and perfect. Excellent.
Great. Thank you, Gordon, John, and Yufei for that great presentation. There were a number of things that I picked up from that, which if we have an opportunity, I'll ask. But I know that we had asked for some questions to be submitted earlier, and what we've tried to do is put them into some common themes, because we did receive a lot of questions pre-seminar, or pre-webinar, excuse me. So why don't I just start with something that is on the minds of a lot of our members. If you look at the market today, we are seeing today, in fact, a significant drop in the market and this increased volatility. And I know you touched on the volatility piece, but what would you say to somebody who is in retirement or approaching retirement, but still needs growth from their investments, but are also concerned about the low interest rate environment and the almost lack of yield that you would get from your investments? What would you say to that type of individual? I'd be curious to hear.
Sure, I can start. So I guess 2 points that I would say to that. First is that, regarding the market volatility, if you look at where stocks are today, we've already recovered all of March's losses and then some. We did see some weakness in September, but it was nowhere near the level of volatility that we saw in March. And so, even though financial headlines, they seem to be dominated by news of the election, virus cases, delays in government support. Even today we're seeing markets down about 1 to 2%. Because it looks like we're not going to see a fiscal bill in the US passed before the election. So I can see why investors are jittery. But, the question I would ask is, when are markets ever not volatile? Over the long term, as investors, especially equity investors, we are compensated by taking equity market risk, and there is no return without taking risk. And so I think, a certain level of volatility is pretty normal, I think is healthy for the markets. My second point is that, regarding investors in retirement, even though we are back in a bull market and we're optimistic on the stock market over the long term, we do think that the market regime has somewhat changed. So if you look at, interest rates, we're back near all-time lows, which further drags down government bond yields. As I mentioned earlier, a 10-year Government of Canada bond today yields about 0.6%. So that's your average annual return. If you bought a Government of Canada bond and held it to maturity, even just 10 years ago, the yield was around 3.5%. So 10 years ago, if you bought a 10-year Government of Canada bond, your return would have been about 3.5% a year. Many investors, when they reach retirement and, they switch to GICs thinking that, maybe they need the guaranteed income and don't want to take any market risk. But after tax, after inflation, your real return from guaranteed income products are generally negative. So, this may be a good opportunity. If you haven't done so already, I think this would be a good opportunity to meet with your financial advisor and reassess your financial situation to see if your investments are still on track to help you reach your goals. Because, on one hand, there is the risk of losing money in your portfolio, of course, from market volatility, but there is also we need to consider the risk of not meeting your financial goals in retirement. And so, having that discussion with your advisor, rethinking your risk tolerance or your risk appetite, I think right now would be a good time to do that.
Great, thank you. I think you hit on a very important point there, Yufei, is really talking to the plan. Having the appropriate plan for the right risk tolerance, that you have your risk objectives, and looking at your time horizon. And I think that's something that our Alterna Wealth advisors are very good at doing. We when we try and sit down with members, we really look at the overall objectives for that member. We conduct a full financial plan. We do a discovery exercise, and we engage in the right product solution that will help them reach their financial goals. So very great point there. Thank you for that. Another question that we had that came through was, given that we're not sure, there is a prediction on the U.S. administration on the turnout, what that would look like. With the pandemic, if it goes to a more sour state, the economic measures that could be put in place could be unnecessarily harsh. What impact would that have on the Canadian landscape in terms of Canadian investments if we see a real harsh climate in the U.S. To stem the tide of the pandemic?
Well, I think. Oh, sorry, John. Did you want to?
Oh, go ahead. I'll jump in afterwards.
Okay. So I'll start. I think that what exactly it means by economic harsh environment. I think from both sides we are seeing as we've seen the negotiations in the Congress about this fiscal bill, both sides seem to be willing to move along some measures of support. Just where it's targeting in the details of the plan is a little bit different. I think post-election, what kind of government response would really depend on the outcome of the election. So, and it's not just whether Biden or Trump wins. It's also depending on who takes the Senate. I think the House most likely will remain Democrat control. So if we do have a Biden win, I think it could be very positive for the economy, but it does depend on whether the Democrats can take the Senate. So if you look at just overall policy, Biden does favor more fiscal stimulus targeted at Main Street. So if we see a Biden win and we see a Democratic sweep, then we may actually see a faster economic recovery with more government support measures. If Trump wins and the Republicans retain control of the Senate, which is basically the current situation right now, I think that could also be somewhat positive for the economy. I'd say, the two worst case scenarios, if I were to outline them, would be that, if Biden wins and the Senate remains Republican, or if Trump wins and the Democrats take the Senate. So either of these scenarios just creates more opportunities for political gridlock, which is obviously less than optimal. I think for Canada, I don't think it's as clear cut because both candidates bring their pros and cons. We've obviously seen what Trump is capable of over the last 4 years, attacking Canada on multiple areas with respect to our bilateral trade. And it's actually no surprise that if we look at surveys today of Canadians, that overwhelmingly the majority of them favor Biden over Trump. So even though Biden would create less volatility for Canada-U.S. relations, we also have to remember that Biden also has a bit of a buy American kind of protectionist stance. But his approach may be with softer tactics than Trump. But also Biden does not seem to support the Keystone XL pipeline project, which obviously is a vital project for Alberta and our oil sands, and this is something that Trump actually supports. So all in all, I don't think either candidate brings a clear headwind or tailwind for Canada. We just kind of have to watch and see. I don't know, John, if you want to add anything.
Yeah, no, I just wanted to say I think this is an interesting question because clearly the U.S. is an important trading partner of Canada. 75% of our exports gets exported to the United States, and there's other interesting nuances to this as well. I mean, for me, one of the interesting things that I've been watching is with U.S. President Trump hostility towards the immigrants into that country. Canada has been actually a net beneficiary of that. And if you look at our IT sector, for instance, in particular Southwestern Ontario, the Toronto-Waterloo Triangle, we've been able to create more technology jobs in this area than San Francisco has over the last 4 years. And so I think that is certainly a net positive for technology and employment and GDP. Because increasingly, as we look to the next 10 years, we really need to, and as I mentioned in my opening comments, is that we really need to fund this transition. And our partnership with the U.S. is going to be really important to that. In Southwestern Ontario, for instance, Ford has announced that they are transitioning their production in the Ford plant at the QEW and 403 to electronic vehicles. And again, it's certainly important for us to ensure that we work closely with our U.S. partners and transitioning our economy to very high quality jobs that have growth in the future.
Sean, you're on mute.
Sorry about that. Thank you, Gordon. That's excellent. I think I had one more question, which I think was answered during the presentation when Yufei was talking about the growth in 2012 of the various sectors. And the question was specifically to the rise in technology stocks and when will the broader market catch up? Mm-hmm. And so when you were presenting, you mentioned about the various other sectors that have forecasted stronger growth in technology to the weaker components. So are we saying that the rise of technology has occurred and we will see still some growth in technology, but we will see stronger growth in the other sectors of the economy throughout the next year, 2 years, and so forth? Would that be fair to say from what the presentation?
Yeah, so I think exactly as you said, Sean, I think the big game-changing catalyst here would be the widespread availability of a vaccine, at some point. Right now, there's currently 48 vaccines, I think, under development right now that are in the human clinical trial phase. So right now, as I mentioned, with the earnings projections and what that is reflecting is the market's expectation that at some point next year that should happen. So we should have a widespread availability of a vaccine, because when that happens, that means no more physical distancing measures, which means that sectors outside of tech will start to catch up. So when I talk about consumer discretionary and the industrial sector, two of which really stand out because their earnings are expected to grow 70 to 80% next year. If you think about industrials, these are like your airlines and construction companies. Consumer discretionary is retail and auto sector. And these are industries that will benefit, have a significant tailwind, if with the removal of physical distancing measures. So that's kind of already being started to baked into the market expectations for next year.
Excellent.
Yeah, Sean, I would just jump on that. Just the move for technology this year was widely seen as a defensive move because of the as Yufei mentioned, the strong earnings growth that we saw in technology, as well as the strong balance sheets. Large of these mega cap companies had a large cash reserves, and so the market move into technology was largely seen as a defensive move. As we start looking to 2021 and that move largely done, and valuations are very stretched in that sector. We will need to see increased confidence in economic growth. And as the market investors gain more confidence that 2021 will be a year of that rebound that Yufei had showed in his chart, and we see strong signs of a rebound, then I think we can see a cyclical rotation and have more confidence in the earnings growth outside of technology that Yufei mentioned. And at that point, you'll see a rotation.
Excellent. John, thank you very much for that, Yufei, as well. Sean, also, thanks for bringing up that question. That question was asked probably more than any other question was with regards to rotation, again, from growth to value and what we see going on. So I think we got a pretty good answer on that regard. There's time for one last question. I do want to ask it because it was asked a few times, and John, it was directed to you, which was, again, that was an excellent presentation on responsible investing and probably a better description of it than we've seen in the past. The question came out, sorry, I'll kind of paraphrase off of two. As an investor, I mean, how can I take advantage? What can I expect from this stance in terms of responsible investing? It seems to be fairly wide-ranging.
Yeah, I mean, what to expect? So I guess from my perspective, there's a couple of things I think thematically that we can expect. One is, as the world starts to transition to a more sustainable future, you can expect your investment portfolio managers to start incorporating some of those themes into their selection of securities. I think that also you can expect greater accountability of responsible investment managers. Again, NEI, we consider ourselves very, very committed to this, and so so some of our strategies, already we report on our environmental footprint that these portfolios are having in our environmental leaders, for instance, in our Global Sustainable Balance Fund, as well as our Global Impact Bond Fund. And you can expect, asset managers to continue to increase their commitment and reporting to these types of metrics. And so again, I think it's really exciting, as more and more investors start to understand the power that their investment dollars can help finance some of these leading industries, you'll see increased growth in this segment for sure. I don't know if that answered your question, Gord. I wasn't really sure.
Yeah, no, I think it was more a broad, kind of wider ranging question as in terms of expectations. Again, it's become fairly obvious through your presentation, others, and we've seen within the media that responsible investing, ESG, sustainable and impact investing are all becoming part of the vernacular as we see it on a day-to-day basis and hear it on a day-to-day basis. So the curiosity is definitely there. As we said, there's been a few questions on it, and I think it dovetailed beautifully into what Yufei was saying about the broader markets. Sean, I'd like to turn it back to you to close it up. And again, thank you for your time. John, Yufei, definitely thank you for your time. And for everybody who's attended today, thank you for your time and attention as well. Sean.
Thank you, Gordon. Just wanted to first of all thank all of our members for dialing in and joining in. I hope you got a lot out of this presentation. I know the timing of this is quite unique, given that the U.S. election is 8 days away. We've got the pandemic around us, and we've got some optimism from what John and Yufei have said about the upcoming year. What I would like to suggest is if we did not get to some of your questions, I know we received some online. We will capture them and try to get back to you. This webinar is being recorded and will be posted on our Alterna Resource Hub. If you have additional questions or you'd like to speak to a wealth advisor, you can send us an email at wealth@alterna.ca. That's wealth@alterna.ca, and one of our wealth advisors will contact you in a short order. The other thing I would like to bring up is that we will be hosting another webinar in November on year-end tax tips and planning. So something that might interest you given the current environment And if you have not seen this webinar, this might be something that you would like to attend. So keep an eye out in your inbox for the year-end tax tips seminar. That will happen around the third week of November, and those invites will go out shortly. With that, again, I wanted to thank you very much. Thank the team for participating on the call, and I'll turn it over to Gordon. I believe he has one last item that he'd like to take care of.
Excellent. Thank you very much, Sean, John, Yufei. And again, we'd like to leave you with again, there was a great comment that just came through, and it said, "Thank you very much for the presentation. More hopeful than I thought." And I thought that really summed up, exactly our view as a company and our outlook as a company is that, again, there's always more of a hopeful outlook than a pessimistic outlook as investors. We're not speculators, we are investors, so we always look forward. And with that, I mean, what I'd like to do is, if we can, and I'd like to do this right here and right now, is share with you something that I think you might find interesting as well. Or more importantly, I think, John, if you can do it, can you share the brief video as well?
Sure, yep, I can totally do that.
Excellent, thank you. I'm having technical difficulties.
Okay, perfect. Okay, let's end it with the video. Questions. Okay, perfect.
Excellent. Thanks, John. With that, we'd like to thank you all again for your attendance. Thank you for attending with us. Appreciate it. And as we like to say, demand more we do, demand more of us, and we will deliver. Again, thanks, Sean. Thanks, John. Thanks, Yufei, and have a nice afternoon, everyone. Take care.